Hello, I'm Michael Hainsworth. You have bonds, you have stocks, but are you really diversified when most of the movement of the indexes comes down to 7 tech stocks? Coming up, we step beyond public markets and into private assets with Byron Monaghan, where many of the companies shaping the next decade are built, financed, and grown long before they ever ring the opening bell.
So if the public markets we see every day represent only a fraction of the global opportunities, what's the biggest risk to ignoring private assets entirely over the next decade?
Well, I think for investors, a growing number of the companies that will be the leaders of the business world of tomorrow are becoming investable exclusively in the private markets. And we're seeing a large number of companies today in emerging industries like AI, for example, remain in the private domain for longer than they may have in the past. So for investors to build a truly diversified portfolio, we think it has become more important to have a line into the private markets and to have a strategy that's well aligned to your portfolio.
From private equity and private credit to infrastructure and real estate, we'll explore how alternative assets can diversify portfolios, why liquidity is the trade-off you need to understand, and why access to private markets may become essential for investors today looking to capture tomorrow's growth. But first, when the Bank of Canada or the U.S. Federal Reserve speaks, markets listen. And while not every word is a surprise, every word signals intent. Why? Because central banks aren't just reacting to the economy, they're guiding it. At their core, they manage two things that matter deeply to investors: the cost of money and the confidence in it. When they raise interest rates, we borrow less, spend less, and slow inflation and the economy. Lower rates encourage borrowing, which puts more money into an economy and increases the risk of increasing inflation. So what policymakers in Canada and the US say about the future can move markets as much as what they actually do. Markets are forward-looking. Central banks know this. And that is why communication has become a policy tool of its own. Carefully chosen language, measured pauses, a deliberate attempt to steer expectations without shocking the system. But central banks aren't omnipotent. An interest rate move today can take up to 18 months to filter down to the economy in a recognizable way. And decisions are made using lagging economic data, basically old news. By the time rate hikes slow inflation, growth may already be weakening. By that time, easing supports, we see new risks forming. For investors, the mistake is treating central banks as fortune tellers. They're not predicting the economy, they're reacting to it. And while they're trying to influence the behavior along the way, it's a bit of a mug's game if you're trying to predict things. It means markets overshoot sometimes, narratives harden, expectations can become detached from reality. The discipline comes from understanding the role central banks play without outsourcing judgment to them. Watching policy signals, but building portfolios that can function across cycles is critical.
Byron, investors often think that the stock market is the center of the investment universe, but really the majority of companies are private. How big is the opportunity set compared to the public markets when we talk about alternative asset investing?
That's right, Michael. Actually, the public markets are only scratching the surface of what is actually investable out there. Turns out roughly 90% of the companies in the US that generate north of 100 million in annual earnings are actually private companies. And in fact, the number of companies listed on the public exchanges are roughly half of what they were back in the 90s. So the trend has been for more private ownership and more private investment.
The public markets have been very concentrated over the last few years. A handful of mega cap tech companies seem to move the needle on the S&P 500 more than anything else. How do alternative assets fit into a model portfolio?
Well, it's true, Michael. Today, roughly a third of the S&P 500 is invested in these Mag 7 mega tech companies. We really view alternative assets as a way to diversify the portfolio, diversify the sources of growth and income, and ultimately seek better long-term outcomes for those clients who can invest a portion of the portfolio in a sleeve of less liquid assets.
You're in such an interesting space at an interesting time, because not only, to your point, do we have these big tech companies controlling the indexes, and as a result, a lot of people's ETFs and their retirement funds, but we're also seeing fewer companies going public in the first place.
Yeah, that's right. I mentioned a minute ago, roughly half as many publicly traded companies today than 20, 30 years ago. It's generally preferred by company management teams to remain private as long as possible. It certainly takes up a lot of resources to manage the next quarterly conference call. It's often preferred to keep some of that financial information private, some of that management discussion information private. And today there's a lot more capital available for companies who do want to raise equity in the private markets. In the past, it would have been much harder. Tapping the IPO market was generally a more popular route. But today, more and more, we're seeing companies stay private for longer or not going public at all.
Where's that capital coming from?
Well, initially, it came from institutional investors who were some of the earlier adopters of private equity in their portfolios. They saw very good outcomes in their private equity investments and therefore were allocating a bit more of their portfolio. And so over time, that allocation from institutional investors did become quite significant. We saw family office investors. Those are multi-generational, fairly wealthy investors begin to adopt the asset class. They also generally tended to perform fairly well. And over time, the investor base has expanded. And now it has become more of a mainstream asset class and in fact is accessible to the private wealth market.
So far, we've learned that public markets represent only a slice of global opportunities because most companies remain private and are increasingly staying that way longer. But what actually makes private assets different from stocks or bonds, and why liquidity is a double-edged sword? I want to talk about that too. Sure, it's the biggest concern, but it's also the biggest source of return.
Private assets have historically required long lockups and large minimum investments.
Yeah, that's right. The typical closed-end drawdown fund structure required a 10-year lockup period, essentially zero access to your capital until the underlying investments were ultimately monetized and the capital along with the gains were returned to investors.
Not the case anymore, though.
Well, these days, so-called evergreen fund structures have become the more preferred choice. These new fund structures exist into perpetuity. They allow for ongoing quarterly or even monthly investments. They offer investors optionality for limited, but still liquidity on a quarterly basis as well. And from an operational perspective, it has just become much more easy to incorporate private assets into portfolios than in the past. And this is a driving force behind the growing adoption that we see in portfolios.
How do we get over one of the key hurdles to adoption, though? And I'm thinking more psychological than actually literal, because liquidity is the number one concern that advisors raise when we talk about alts. What should investors understand about the trade-off between liquidity and long-term return potential?
It's very important. It is a constraint that investors used to dealing with public stocks and bonds are less preoccupied with. But it's very fundamental to the higher returns that we expect from the asset class. In private equity, for example, our partners in private equity, they go out and source opportunities from a very large opportunity set, typically with the intention to acquire a majority position in that company, acquire that business with as good a price as they can on entry, with the intention to make that business more valuable over a 5 to 7 year holding period, initiatives that will improve revenue, initiatives that will improve margins. And then ultimately they will seek to monetize that company by selling it to another larger corporate entity, to another private equity investor, or potentially going through the IPO route. So it is that process that generates the attractive returns. And it's also that process that is inherently illiquid and requires that more patient approach from the investor.
Okay, but let's talk about inputs as well. Interest rates have moved dramatically over the past few years. How has that affected deal activity in private equity and private credit markets?
It is true. Higher interest rates tend to raise the cost of capital, which tends to depress deal activity in the private markets. Also has a generally negative impact on valuations. And that dynamic played out especially significantly as it relates to real estate as an asset class. But private equity was not immune from that development either. Private credit, which is typically a floating rate asset class, benefited tremendously from the rising rate environment. At the peak of the cycle, there was offering yields into the double digits. And now this trend has started to reverse. Interest rates have come down. They're still on their way down. And that has spurred deal activity and has been a tailwind to valuations as well.
Oh, you brought up something interesting, that interest rates are still on their way down. Is that your perspective? There seems to be very much a bifurcation between American interest rates and Canadian interest rates. How does that factor into all of this?
Well, that's a very interesting point. The private equity market is a global market. And so the intention is to invest where the opportunities are. And so a diversified portfolio will have a line into the various developed markets, the opportunity to generate returns where these projects offer opportunity and long-term gains. The cost of capital is directly linked to the interest rates. That also has an impact on currency valuations and currency risk as well. And so for us, we intend to pursue a global strategy so that we have diversification and can manage those types of risks inside of a portfolio.
Yeah, I think I just revealed my North American-centric view of investing. And a very important point, of course, is that we're seeing sort of an exodus out of North America and into places like Europe for stocks and bonds right now. So I can imagine alts is not that much different. But talk to me about here at home, because so many Canadian investors want to put their money where they live. Canada has increased the review of foreign acquisitions under the Investment Canada Act. How do you address the uncertainty for private capital?
Well, I think the uncertainty in private markets is very similar to the public market aspect of things. We're investing in companies who deliver products and services that have value to the consumer. And there are risks in terms of sourcing the inputs into those products. And there's risk as it relates to the distribution of those products. And in an international market, that can present some challenges, especially when you're crossing borders. But this is a risk that has been persistent in the past and will continue to persist in the future. Companies are dynamic, and the best ones are able to navigate change. But ultimately, we aim to manage that sort of a risk through diversification in a global portfolio.
Yeah, the Canada Pension Plan is under tremendous pressure right now to invest locally in our country, but we as individual investors don't have that kind of pressure. Globally speaking, where in the world appeals to you now?
Well, when it comes to private market activity, what we see in places like the US, for example, it's a fairly deep and diversified and mature private markets ecosystem. We do see, especially in areas like Silicon Valley, a lot of the startup technology companies tend to emerge from pockets such as those around the world. But Western Europe, the developed markets within Europe also have some very interesting opportunities. And so that's predominantly where we would be focused in the United States, in Western Europe. The Canadian market does offer some opportunities, especially in the earlier stage businesses. But again, it's helpful to cast a wide net. And to invest in opportunities that not only have the risk return characteristics that you're looking for, but also the liquidity. Because in private markets, the liquidity dynamics can vary as well by asset class and by strategy.
And also by region?
Yes, well, by region as well. The volume of activity influences liquidity. And a market like Canada, for example, would experience a lot less volume than a market like the US, again, which tends to be a bit more diversified, have a lot more companies that are emerging in this technology vertical, and also have a very large and diversified public market, which ultimately feeds off of activity in the private markets.
Has anything that's going on in the world today changed your investment thesis, or is this more of a slow and steady wins the race kind of scenario?
Again, the geopolitical uncertainty is nothing new. If it wasn't this, it would be something else, and it will be something else in the future. I think that it's important to understand fundamentally how you expect to generate returns in your portfolio. We think in the private markets, there are very robust platforms that can generate these returns for investors over the long run. Diversification, they say it's the only free lunch in finance. And so we want to be able to be invested in certain areas that are uncorrelated to one another, where the risk factors are not necessarily overlapping to a large extent. And I think by taking that kind of an approach and maintaining a long-term view, I think that will pay off in the long run.
We've explored the mechanics behind private assets, the liquidity trade-offs, the role of interest rates, and why global diversification matters in private markets as much as public ones. But let's get practical. Who should invest in private assets? How much belongs in a portfolio? And which strategies make sense? And most importantly, when it comes to this investment vehicle, am I buying the right mustard?
Let's come back to something that I sort of touched on at the beginning of our conversation. Historically, private assets were almost exclusively the domain of institutions, ultra-wealthy investors, the Grey Poupon set. But but that's not the case anymore. Tell me about the new fund structures specifically that I can take advantage of, because I've already got my stocks, I've already got my bonds, but I'm just a regular Joe.
So you're right. The private markets really began as an institutional allocation in portfolios. And over time, we've seen it be adopted by very wealthy individual investors. And now these new fund structures do make it more accessible and easier to implement for other types of investors as well. Important to remember that the liquidity dynamic does remain very real. It's not necessarily suitable for everyone all the time. But again, we do see a lot of investors who can benefit from even a small allocation of private assets in their portfolios.
So then for whom is this an appropriate investment?
So we think it's an appropriate investment for an investor with a relatively long time horizon who is looking to diversify their portfolio with alternative sources of growth and income, and looking to benefit from diversification.
You said that the time frames are often a decade. So when you say that long-term time frame, are we talking about people who are not yet retired and they're still in their working years, or is this more of an income generation opportunity for those who've already retired?
So for the investor who's still relatively young, who's looking to compound growth in their portfolio, who's still in the accumulation phase of investing, an asset class like private equity can be very helpful, can provide a good long-term boost to returns and also diversify their public equity investments. And then for those investors who are more on the income phase of their life cycle, an asset class like private credit can pay an elevated floating rate yield that can be, again, a diversifying source of income to help them finance their lifestyle. And then in the middle, you have your real assets, real estate and infrastructure, which can deliver a blend of income and growth, and again, can be very diversifying to a portfolio of primarily financial assets. So again, it's not just private assets or for one type of investor. I think the selection within this big group of asset classes will depend on your objective. But ultimately, the constraint is, are you willing to allocate, say 10 to 20% of your portfolio to some assets that you can't necessarily sell overnight?
Okay, so then let's go through those three asset classes, specifically private equity. Historically, delivering outperformance over public equities. You pay a bit of a premium for that. What drives the return advantage?
So I think it's really the three stages of the investment process. I mentioned before the opportunity set in private equity, it's orders of magnitude larger than what's out there in the public markets. And so the top private equity investors, they're able to identify these opportunities, be in a position to acquire companies with good long-term potential and acquire them at good prices. And the typical playbook is to own these companies for a period of 5 to 7 years, improve the business, grow the earnings, and then ultimately sell that company to crystallize the gains. So the top private equity investors, they are also operational experts who can help these companies become more valuable, who can make them more efficient, who can help them enter new markets, help them with their product development. And then at the end of that ownership period, you have a look at conditions in the capital markets and you say, is it a good time to IPO business? Is there a larger corporate entity who would be a good buyer for this type of a company? Or is there another private equity investor who is looking to invest perhaps at a later stage than I am? And so it's through that process where there's lots of value to be added if you're working with capable private equity investors.
And then on the private credit side, again, if you might be a little bit older, maybe you've already retired, you want that regular income, you don't want to, cut down the tree, you just want to eat the apples. Private credit really offers that income by lending directly to the companies. What about the yields?
The yields are attractive. We're talking about quarterly distributions in today's environment that are in the high single digits. So relative to high yield bonds, relative to investment grade bonds, relative to GICs, you're certainly able to pick up significant yield. And the trade-off for that would be, number one, credit risk, right? You do tend to get paid in excess of investment grade bonds when you do take on some credit risk. So that is one factor. But another factor here is the liquidity risk. These loans are underwritten with the intention to be held to maturity. And private credit is typically a 5-year term to maturity. In private credit portfolios, you do typically see annual turnover on the order of 20-25%. And it is from there that the fund will source liquidity. But again, it's directly related to that return premium. Because in more traditional credit investing, there was a bank involved in the origination of that credit and in the making of a secondary market for that credit. And those banks get paid in both of those activities. In private credit, The loans are being originated by the private credit fund manager, and they're being held to maturity without the intention of trading. It is by disintermediating the banks in that process that we're able to generate some of the excess return. And so again, that's a trade-off that is not necessarily for everybody, but for those who are building a diversified income-oriented portfolio, we think private credit can really be a useful tool in that mix.
So if private equity is more for a younger investor with a longer time horizon, private credit is more for the older investor who wants to get some cash coming in the door. You mentioned real estate. Are we talking infrastructure here? Or are we buying ports, airports, and places where the boats dock? Like for whom is that an appropriate investment?
When we talk about real assets, the two main categories would be real estate and infrastructure. And so real estate, multifamily residential properties, commercial and industrial properties. And then on the infrastructure side, transportation assets, digital infrastructure, and also energy, and especially renewable energy. Those would be the three main themes in infrastructure these days, both of which can be very diversifying relative to a portfolio of more financial assets. Both offer very contractual, long-term, inflation-adjusted cash flow, which is helpful in a portfolio, in an income portfolio where you're trying to protect the purchasing power of that portfolio. And they also offer some additional upside in the form of some of the value creation or the development work that's done in some of these strategies as well. And more income, more conservative-oriented investors in these asset class will be more after the income stream and the stability, whereas more growth-oriented investors might be more interested in the development projects, which might not necessarily pay a cash flow immediately.
So it sounds like what I'm learning here is that investors should be treating private assets as a complement to traditional stocks and bonds. It's a focus on diversification. Your time horizon needs to be a little bit longer, and you have to come up with an appropriate allocation level. You throw out, 20% or so. Is that generally 1/5 of your investable cash should be allocated to this if you're in this position?
It's very much a case-by-case basis.
Sure.
We say if you are going to do it, doing it in enough size that it is going to meaningfully impact the performance of your portfolio. So we typically say 10% in situations where it is suitable, and then go as high as 25%. In that case, you are going to meaningfully boost the expected return of your portfolio over time if you have similar expectations as we do, but you still retain 75% plus of the portfolio in liquid assets that you can access very quickly in the event you do have unplanned cash flow requirements in your life. Because again, the primary trade-off for the enhanced returns and the stability that we tend to expect from private assets is that limited liquidity. So just ensuring that you're fully aware of the liquidity dynamics, how long does it take to exit these strategies when it comes time to do so, and then gaining comfort with that and sizing the position according to your situation is really the way to go.
So if the public markets we see every day represent only a fraction of the global opportunities, what's the biggest risk to ignoring private assets entirely over the next decade?
Well, I think for investors, a growing number of the companies that will be the leaders of the business world of tomorrow are becoming investable exclusively in the private markets. And we're seeing a large number of companies today in emerging industries like AI, for example, remain in the private domain for longer than they may have in the past. So for investors to build a truly diversified portfolio, we think it has become more important to have a line into the private markets and to have a strategy that's well aligned to your portfolio. The build out of the electrical grid, of the data centers that are going to power the industrial revolution that we currently find ourselves in is going to require a lot of capital and a lot of private capital. And we think this also offers investors a once in a generation opportunity.
Last question. Do I need to stock up on Grey Poupon?
Sure, Michael. I like Grey Poupon. Stash some for me.
Byron, this has been an education. Thank you for your time and your insight.
Thanks, Michael. It was a pleasure chatting with you.
Private assets are no longer the exclusive domain of pension funds and the ultra-wealthy. As Byron explains, the opportunity set is vast, the diversification benefits are real, and the next generation of industry leaders may never reach the public markets at all. But the trade-off is patience. These investments demand a longer time horizon and a willingness to give up daily liquidity in exchange for new sources of growth and income. In the end, private assets are not a replacement for stocks or bonds. They're a complement, a way to broaden the portfolio, tap into opportunities beyond the public markets, and position for the long term. It's the way to stay on the money. I'm Michael Hainsworth. Thanks for joining us.